Retirement planning can be an intimidating prospect, especially with the decline of traditional company pensions. Many individuals find themselves responsible for managing their savings without being financial experts. Fortunately, Suze Orman, a renowned personal finance expert, offers valuable guidance to navigate the complexities of retirement planning. Over the past 50 years, Orman has assisted clients in achieving financial security, and this guide focuses on her strategic approach to retirement planning in the United States. The insights cover pragmatic advice on challenging topics such as supporting financially dependent adult children, along with practical tips on investments, spending, and savings. The approach begins by considering your current situation rather than an idealized one, aiming to alleviate worries and fears while building a path towards your optimal retirement. Throughout this journey, you'll discover techniques for living beneath your means but within your needs, managing investments during market downturns, and leveraging the benefits of downsizing to enhance your savings plan. Planning for retirement has become significantly more complex than it was in the past. A few decades ago, retirement was relatively straightforward, with most individuals receiving a pension that guaranteed a monthly income after years of service. Managing retirement funds and investments was not a concern for the retirees of that era. However, the landscape has changed for today's retirees. The key point here is, planning for retirement is a lot more complicated than it was in the past. Traditional pensions are now primarily found in the public sector. For those outside government employment, funding retirement typically involves employer-sponsored plans like the 401k or personal savings plans like the Roth Individual Retirement Account, Roth IRA. Understanding the tax implications of contributions and withdrawals is crucial in these plans. Determining the appropriate withdrawal amount during retirement is vital, as withdrawing too much early on can lead to financial difficulties in later years, especially with increased life expectancy. Additionally, the current low interest rate environment poses challenges for living off investment income, making it harder for retirees to sustain their lifestyle. Considering the unpredictability of the stock market and the potential for economic downturns, such as the 2008 recession, individuals nearing retirement or those in the early stages of retirement may feel overwhelmed by uncertainties. While there are challenges, the good news is that with determination and access to the right information, individuals can navigate this complex landscape and build confidence in their retirement planning. Retirees with financially dependent children need to establish clear boundaries to ensure their financial security. The primary message here is, retirees with financially dependent children need to set ground rules to guarantee their financial security. Unlike previous generations, contemporary parent-child relationships often involve adult children living with their parents well into their 20s or 30s. While providing support during this transitional period is reasonable, allowing children to become financially dependent poses risks. To secure your own financial well-being in retirement, it is crucial to set boundaries that encourage your children's financial independence. This is not about adopting a tough love approach but rather fostering genuine support. If you consistently cover your children's living expenses, including housing, groceries, or vacations, you hinder their ability to take control of their lives. Additionally, this behavior could harm your own financial stability. Money spent on your children at the expense of your retirement savings may lead to dependence on their support later in life, creating a situation where neither party achieves financial independence when needed. To establish clear boundaries, consider the following 3 ground rules. 1. Require adult children living with you to contribute rent without exceptions. 2. Provide conditional financial support, encouraging responsible financial behavior and independence. For instance, supporting them in renting a shared apartment while saving for a house is reasonable, but funding an expensive independent living situation they cannot afford is not advisable. 3. Avoid co-signing for your children's loans. Despite trust in your children's intentions, co-signing introduces unnecessary financial risks. If unforeseen circumstances, such as job loss, arise, you may find yourself responsible for repaying loans instead of securing your retirement funds. You can significantly increase your retirement savings by making informed choices about your vehicle expenses. The central message is, you can save a lot of money by making smart decisions about the car you drive. For individuals still in the workforce, prioritizing savings is crucial for enhancing their retirement fund. While many prospective retirees struggle to accumulate the necessary funds, there's a straightforward solution: understanding where to cut back. Although reducing spending might seem like a sacrifice, every dollar saved today translates to reduced financial burdens during retirement. In essence, trimming current expenses minimizes the financial resources required for a comfortable retirement. One expense that can be significantly reduced, although not eliminated, is your car-related costs. If you're financing your vehicle through a loan, it's essential to follow a general guideline. Avoid committing to a loan that cannot be paid off within 3 years. If a 3-year payoff is unaffordable, it indicates that the car is beyond your financial means. While opting for a shorter loan period means higher monthly payments, it results in lower overall spending. Rapidly eliminating debt on a depreciating asset reduces the total interest paid over time. Additionally, you can cut costs and allocate more funds to your retirement savings by purchasing a slightly used car instead of a brand new one. Focus on certified pre-owned (CPO) deals, which involve used cars thoroughly inspected and accompanied by an extended warranty. Typically, CPO cars cost up to 40% less than their brand new counterparts. Another strategy is to aim for a decade-long ownership of your vehicle instead of trading it in every few years. The primary objective is to pay off the loan as quickly as possible, maximizing the years during which you channel funds into retirement savings instead of servicing debts. You can significantly boost your retirement savings by minimizing housing costs, even if it means downsizing. The main message here is, reducing housing costs allows you to turbocharge your retirement savings. While the idea of aging in place, remaining in one's home for as long as possible, is appealing, retirees may find it financially advantageous to move to a smaller residence. Although the emotional attachment to a home is strong, it's essential to recognize that memories and traditions are portable. People matter more than places, and embracing change can lead to the creation of new traditions and memories. Downsizing and cutting housing costs present a practical financial strategy. A smaller mortgage, for instance, enables increased contributions to savings, early debt repayment, or delayed Social Security claims until the 70s. Instead of focusing on what is sacrificed in the short term, consider the long-term gains, such as financial peace of mind. Illustrating the proposition with numbers enhances its appeal. Suppose you plan to work for another 10 years and downsizing reduces housing costs by 25%. If your current monthly payment is $2,000, downsizing frees up $500 each month. Over a year, this amounts to $6,000, a valuable emergency fund or debt elimination. For those already debt-free, the extra funds could cover travel expenses or contribute to a Roth IRA. Over 10 years with a 5% annualized return, this could result in over $75,000 in tax-free retirement savings. Importantly, downsizing in this manner allows for the maintenance of independence. While not residing in the original family home, retirees can still enjoy the benefits of living in a home of their own. Remaining patient in turbulent markets is crucial even in retirement, but having an emergency fund is essential to support this strategy. The main message here is, patience pays in turbulent markets even when you're retired, but you need an emergency fund to cover this strategy. As you retire, your investment portfolio continues to function, and it's crucial to resist the temptation to sell when the stock market experiences downturns. Bear markets, where stock prices drop by at least 20%, have occurred 7 times since 1970. Despite these downturns, historical data shows that staying invested in an S&P 500 index fund has yielded significant returns over the long term compared to keeping money in a bank. Toughing out bear markets remains a sound strategy in retirement, but additional considerations arise. If a bear market occurs early in your retirement, there's a risk that ongoing withdrawals from a weakened portfolio might jeopardize its longevity. Selling stocks during a downturn exacerbates the problem and makes it challenging to re-enter the market when conditions improve. The solution is to stay invested, allowing your portfolio time to recover, typically around 2 years. Preparing for this scenario before retirement involves creating an emergency fund capable of covering living costs for at least 24 months, ensuring financial stability during bear markets.
Welcome to our self-development book summary channel, where a treasure trove of transformative insights awaits, especially if it's your first time here. Surprisingly, 70% of our listeners haven't subscribed yet. Join us on this journey of self-discovery and continuous improvement by hitting the like, subscribe, and share buttons, and don't forget to turn on the notification bell. Your support propels us forward, allowing us to delve deeper into the realms of self-development. Cheers to a community committed to learning, evolving, and embracing the transformative power of books. Like, subscribe, and let's embark on this empowering adventure together. Now, let's return to the review. Thanks for being part of this journey.
To avoid running out of money during retirement, it's crucial to assume a longer lifespan, such as living to 95, and factor in inflation when planning. The main message here is, to avoid running out of money, assume you'll live to 95 and take inflation into account when you plan for retirement. People often struggle to connect with their future selves, leading to a tendency to focus on immediate concerns rather than long-term financial planning. Considering the increasing life expectancy, assuming you'll live into your 90s is prudent when planning for retirement, even if you don't have a specific health condition limiting your lifespan. Inflation is another vital factor to consider. While inflation rates may be low at present, even moderate rates accumulate over time, impacting the purchasing power of your money. For instance, if inflation runs at 2% per year for 2 decades, you'd need $1,650 to cover expenses equivalent to $1,000 today. To counteract the effects of inflation, investing in stocks is recommended. Historically, stocks have provided returns above inflation rates over extended periods, making them a valuable component of retirement plans. In the next section, strategies to balance the risk of stock market investments with the security of a guaranteed income will be explored. An income annuity offers a solution for retirees seeking stability and security by providing a guaranteed income that complements stock market investments. The primary message here is, an income annuity provides a guaranteed income that offsets the demands of investing in the stock market. When planning for a multi-decade retirement, considering inflation is essential. While stocks have the potential for inflation-beating gains, bear markets can lead to significant fluctuations in their value, making it challenging to draw a steady income. To address this challenge, an income annuity offers the best of both worlds by providing stability and managed risk associated with stock market investments. An income annuity is a form of personal pension created by exchanging a lump sum with an insurance company. In return, the insurance company commits to delivering a fixed monthly payment once the annuity starts. The amount you receive depends on the upfront payment and the duration of annuity payments. For example, in late 2019, a 70-year-old woman seeking a guaranteed monthly income of $1,000 for life might pay around $200,000 for an income annuity. If a 70-year-old man married to a 67-year-old woman wanted the same income until the surviving spouse's death, the cost might be approximately $220,000. While the idea of committing a significant sum to an insurance provider might seem daunting, the peace of mind and security offered by income annuities can be valuable. Income annuities don't require active management, eliminating concerns about bear markets or the need to rebalance portfolios. Once the payment is made, retirees receive a fixed monthly income, providing confidence to keep a portion of their savings in the stock market to generate inflation-beating yields.
Creating 2 essential documents, a will and a living revocable trust, can protect yourself and your loved ones, addressing topics related to illness and death. The primary message here is, you can protect yourself and those you love by creating 2 vital documents, a will and a living revocable trust. A will serves as a crucial document to outline your preferences for inheriting specific items, such as jewelry or heirlooms. However, it is not the ideal document for distributing significant assets like savings and property. If you rely solely on a will, the probate process, involving court approval, becomes necessary for asset distribution. Probate is complex, time-consuming, and often expensive without legal expertise. To simplify the process and avoid probate-related challenges, consider creating a living revocable trust. This legal document establishes a trust that you fund by transferring ownership titles of assets, including real estate and financial accounts, to the trust. Unlike a will, a living revocable trust eliminates the need for court approval, streamlining the distribution of assets according to your wishes. Beyond simplifying asset distribution after death, a living revocable trust offers an additional advantage during your lifetime. By appointing trustees, including yourself, your spouse, and a successor trustee, you empower individuals to manage trust assets. This becomes crucial if you face conditions like dementia or Alzheimer's, ensuring your financial affairs are handled appropriately even if you become incapacitated. In summary, creating a will and a living revocable trust provides an actionable plan to build a secure and comfortable retirement while also ensuring the well-being of your loved ones after your passing. The key message in these insights is that planning for retirement has become more intricate, requiring proactive measures for a comfortable retirement. Tips include saving money by making smart decisions about vehicles and housing, staying invested in the stock market during retirement, and creating essential documents like a will and a living revocable trust to secure your financial legacy. Additionally, the advice suggests considering online savings accounts for better interest rates compared to traditional banks. This proactive approach can contribute to a secure and fulfilling retirement. Welcome back, and a heartfelt thank you for rejoining our knowledge-rich community. Within these digital walls, you'll discover a treasury of engaging book summaries crafted to equip you with insightful reflections and motivational narratives, encouraging profound actions. As we strive to broaden our impact and share the joy of learning, we extend an invitation for your support, simply by liking, sharing, and subscribing to our channel. Your support isn't just valued, it serves as the bedrock of our mission. In return, we commit to consistently furnish you with top-tier book summaries promptly. Let's persist in this collective journey toward growth and enlightenment. Here's to delightful reading, perpetual learning, and continuous personal development.